In SMC trading, liquidity and inducement are not the same thing. If you want to find out the difference between inducement and liquidity, watch this video till the end. An inducement is a fake move that causes market participants to make early or late decisions in order to manipulate their positions so the market can generate liquidity to fuel the original move. Now, manipulation, on the other hand, is the process by which the positions of the early or late market participants in the definition above are liquidated to generate liquidity. Now, lastly, liquidity is the consequence of this manipulation. All right. Liquidity basically means money. When we talk about liquidity, fresh volumes can either be introduced into the market or it can be grabbed from zones of residing liquidity. On the charts, you can see that price has been in an uptrend. So this is the origin of the uptrend, this low. All right. And price has been breaking multiple structures to the upside. Now, in smart money, we understand that the institutions can move price. Okay, so whenever there is a new break of structure, we understand that institutions have gotten in and there has been an expansion. Now, what happens is that the people who got in from this level here, after this old high has been taken out, they are taking profits here. Now, in order to take profits from a buy trade, you have to sell your positions. So that causes this little retracement that we can see, okay? This is not a valid supply because it did not take out the previous low that sponsored that high. So institutions get in again at this point and they are buying. Now, after taking out this high, they also will take profits at this high. So anytime there is profit taking, there is a retracement that follows because in order to close a buy position, you have to sell it. Now, remember that some market participants got in at this level and took profit here. Other market participants got in at this level, they took profit here, all right? Other market participants also got in at this level of demand and took profit here. Now the demand is weakening because price is in a premium. So in order to continue the buy move, price has to come back into discounted pricing. Now what happens is that the market is going to induce the most recent level of demand. At this level, price is premium. So the late buyers that are coming in at this level of demand, hoping to continue the buys to the upside, price is going to manipulate their positions. All right. So price is going to come in, take them out. And this is going to become what? A change of character. Now, early sellers are also going to be induced because they are going to see this as a reversal. To them, this is a break of structure to the downside. Remember, in the laws of demand and supply, we say two breaks of structure confirm a reversal. So the first break of structure is what we call a change of character. Now, a change of character doesn't always signal a reversal. All right, a change of character might be price coming in to take internal range liquidity so that we can continue to fuel the main move. Every time there is a reversal does one of three things. It comes to take internal range liquidity to rebalance an old imbalance, and it comes back to trade within the range. Now, in earlier lectures, I talked about a defined range. If you don't understand what it means to say a reversal comes back to trade within the range, scroll down and find the video on defined ranges. After this short-term reversal has taken internal range liquidity, there is going to be a continuation. But now the early sellers who have seen the first break of structure and want to get into the market, they will also be positioned at this supply. Now, mind you, that's a valid level of supply. The problem with that supply is that it only sends price to come and take internal range liquidity. So by the time price is coming back, those early sellers will also be manipulated out of the market. Most times you are going to see that price is going to react from that supply and then take them out because the supply is a valid supply, just that the market is not bearish. That sell leg only came to take internal range liquidity. By that, late buyers that got in here have been induced. Early sellers that got in here have also been induced. And the process by which the positions of the late buyers and early sellers are liquidated to generate liquidity to fuel the main move is called manipulation. An inducement is an event. It is not exactly a part of structure. So there is no such thing as inducement liquidity. No. Inducement is meant to generate liquidity. So the end game of the market inducing a level of demand or supply is to generate liquidity to fuel the main expansion move. The process by which that liquidity is being generated is called manipulation. So inducement is the cause of manipulation. Manipulation is the effect of inducement. And the end game of inducement is to generate liquidity. So liquidity and inducement are not the same thing. In the next episode, we're going to be talking about institutional order flow. All right. You might have been hearing it a lot as an SMC trader. IOF, institutional order flow. If you are not already following the page, follow the page, like this video, share so that others can see it and it can also help them. So stay tuned. I remain your favorite SMC tutor, Goldman Effect. Thank you for watching.